Tesla's stock is up this morning, continuing its upward trend that began earlier this week when the company's second quarter deliveries exceeded analysts' predictions. The last 5 days have seen a 20% increase in shares. With optimists, we've come a long way in a short time, from someone posing as a robot dancing in a suit to a fairly basic robot to a robot that is actually performing useful jobs in the workplace today. It's clear that Tesla is much more than just an automaker. At Tesla, a significant portion of our engineering work is devoted to software development. Therefore, Tesla is a software firm just as much as it is a hardware company. Since automakers are not usually software companies, this is a significant development. This is very important, particularly for our energy storage systems, Megapacks, Powerwalls, solar solutions, and other software that manages our automobiles and autopilot software. You're gaining insight if all you've been considering about Tesla is its ability to produce cars. But now is the moment to cast a larger net. We explore Tesla's enormous potential in this episode, which goes beyond just cars. Expert with a keen eye for industry trends, Keith Fitzgerald offers information that could alter your perception of Tesla. Fitzgerald believes that Tesla still has a lot of untapped potential. He expects the company to grow significantly over the next few years, potentially double or tripling in value. This expansion is supported not just by their well-known driverless cars, but also by fully autonomous driving technology and energy solutions, two fields that Tesla has not yet fully entered. But before we dive in, don't forget to subscribe to Tesla Stock News and remember to like this video. Now, let's explore further. 95% of analysts who have undervalued Tesla in the past consider the company to be nothing more than a car maker, which is a huge misconception. Fitzgerald highlights Tesla's revolutionary potential in fields like robotics and artificial intelligence, speculating that the company may be among the most inexpensive AI companies available today. This opinion is supported when weighing Tesla's current market value in relation to its prospective gains. Just give your attention while we continue. There's no need to click or purchase anything. In a video that we are going to play, Fitzgerald expresses his optimism about Tesla and raises the possibility that the company's stock could reach $300 by the end of the year. Keith, you continue to be positive on Tesla, I should say. Is this stock going to be $300 by the next year? Indeed, I am. In the coming years, I believe the stock will double, quadruple, maybe even more. Once more, we are still in the early stages. I think it's really smart of anyone to think about this only in terms of cars, but they should really expand their horizons. This has to do with robotics and power. It may be the world's finest underappreciated AI play at the moment. Whether you like him or not, Musk is skilled at what he does. While a 20% rise from where it is now is noteworthy, the bigger picture is what really needs to be understood. The huge unrealized potential that might soon see the stock double or triple in value is more important than the meager 20% increase. Why does this matter? Because it changes the perception of Tesla from a conventional automaker to a pioneer in robotics and artificial intelligence. Given this, Tesla might be the best investment opportunity for AI at the moment. Whether you like him or not, Elon Musk's business acumen is making Tesla a major force in technological innovation overall, as well as the automobile industry. This is about electricity, robots, and leveraging one of the market's most underappreciated segments. It's not just about vehicles. Stay tuned as we examine why Tesla could be the AI race's underdog, poised to transform not only transportation but also our everyday interactions with technology. In only the last 30 days, Tesla's stock has increased by an astounding 45%, a surge that should unnerve any investor. But as the saying goes, when in doubt, zoom out. Tesla's stock has lost 6% of its value over the last year, bringing it back to its previous level. Actually, a market correction has taken place, dispelling the uncertainty and gloom that previously hampered Tesla's prospects. Let us now talk about the details. Regarding delivery figures, Tesla encountered skepticism as some market observers forecasted a decline because of a purported demand issue. However, the delivery statistics dispelled the unfavorable narrative and exceeded expectations. Adding to the confidence is the expectation that Robotaxi Day, which is scheduled for August 8th, will dispel more doubts. Crucial is Elon Musk's approved compensation plan, which gives him a 25% stake in Tesla. This is not only about the money, it's also about solidifying Musk's dedication to Tesla and freeing him up to lead cutting-edge AI initiatives without being sidetracked by other endeavors. This decision supported Musk's long-term strategy for Tesla and coincided with the settlement of associated court concerns, which contributed significantly to the recent price spike. Moving forward, the truth contradicts the critiques leveled at Tesla for lowering car costs, a move some saw as an indication of declining demand. This is a smart move of the very competitive auto industry, since it probably fits with larger market penetration and volume sales. Stay tuned as we prepare for Robotaxi Day. Tesla's journey is far from finished, and there is still a lot of room for advancement in robotics and artificial intelligence. Keep an eye out for these changes, stay educated, and think about the wider ramifications of Tesla's tactics in transforming not only the automobile sector, but also the global technology scene. In an environment where rising interest rates are affecting consumer spending and automakers are finding it difficult to move cars off their lots, Tesla has distinguished itself with its astute pricing choices. Because of its best-in-industry margins, Tesla was able to lower prices more affordably than Ford and GM. This has positioned Tesla as a leader in both market strategy and operational efficiency, in addition to helping to maintain sales volume. Critics can contend that Elon Musk's decision-making has swerved or that his participation with Tesla has diminished. The choices made in the last few months, however, seem to indicate differently. These are the choices made by a leader who is still acutely aware of the demands of the business and the state of the market. Though traders should exercise care, long-term Tesla shareholders still have a bright future ahead of them. Expectations are extremely high as August 8th, which is seen as a big date for Tesla's robotaxi debut, approaches. This might be a risky period for swing traders and short-term investors. If the event doesn't produce anything spectacular, the stock may see a sell-off, following the traditional buy the rumor, sell the news pattern. Thus, proceed with caution and prudent asset management on this date. Like many experts, they take a long-term approach to investing, using dollar-cost averaging consistently and avoiding market timing. It's a more reliable strategy because trying to time the market to get rich quickly is frequently the fastest way to lose money. To be transparent, I have 20% of my portfolio invested in Tesla, which reflects my positive outlook for the business. Taking a broader view, the markets for robots, fully autonomous driving, and energy are expected to grow substantially above Tesla's current valuation, possibly contributing an additional $3 trillion by the end of the 10th year. These fields represent unexplored markets with revolutionary potential, particularly robotics and FSD. The transformational impact could be enormous, even though the precise magnitude is difficult to determine. With revenues and share prices soaring, NVIDIA, for example, has demonstrated how profitable it can be to enter new tech areas. Tesla and similar companies are expected to continue a similar trend. They haven't had this kind of growth yet, but as they open up these new areas, that is anticipated to change. Based on anticipated future cash flows, a discounted cash flow (DCF) model, a crucial tool in investment analysis, can be used to estimate a company's prospective financial trajectory. Using a DCF model on the specially created Stock MVP platform, Tesla is projected to see yearly revenue growth of between 40 and 50% over the following 5 years. It is predicted that this expansion would happen in a parabolic spike rather than gradually. This pattern is similar to NVIDIA's past growth history, which saw first modest gains followed by a sharp acceleration when new technologies and market adaptations gained traction. Tesla's remarkable expansion can be ascribed to its tactical progressions in 3 pivotal areas: energy solutions, robotics, and fully autonomous driving capabilities. Not only does each of these industries signify a substantial extension of Tesla's business model, but it also opens it access to larger, quickly growing markets. Innovations in robotics and artificial intelligence, AI, have the potential to completely change a wide range of industries, including manufacturing and services, and advances in FSD technology will completely change the transportation sector. Comparably, Tesla's energy-related endeavors, especially in the areas of renewable energy and battery technology, correspond with global trends towards sustainable energy sources. According to the DCF study, which takes into account risk and time value of money by incorporating a weighted average cost of capital, WACC, of about 10%, Tesla's stock is currently undervalued by about 100%. This undervaluation, which suggests a reasonable current price objective of between $490 and $500 per share, is generated from comparing the projected cash flows discounted back to their present value with the current market price. With a 5-year price goal of $1,400, Tesla is demonstrating its confidence in the significant development and profitability of its energy, robotics, and FSD areas. This goal is based on the assumption that these markets would not only expand more quickly than they already do, but also start to account for a bigger share of Tesla's overall market capitalization. These forecasts are based on the expectation of ongoing technological advancement and rising consumer demand for integrated technology solutions, which Tesla is uniquely qualified to deliver. The financial modeling essentially indicates that Tesla is about to enter a phase of considerable wealth generation, propelled by its innovative and strategic expansions into areas that are expected to have large future growth. Using sophisticated analytical tools on sites such as stock